Welcome to the Opening Bell Report.
Usually when we sit down to prepare a deep dive, we're looking at charts that tell a coherent story.
Right.
You see a trend line, maybe a slow, steady climb, or, a jagged line that tells the story of a turnaround. Standard stuff.
Business as usual.
Yeah.
The market behaving like it's supposed to.
But what we are looking at today, I hesitate to even call it a chart. It looks like a glitch in the matrix. I actually refreshed my terminal 3 times.
It does. It looks like a system error. Less of a financial trend and more of a physics experiment gone wrong.
We are talking about the events of January 29, 2026. The subject is Tech Create Group Ltd, ticker TCGL. In a single trading session, this stock didn't just move.
No.
It effectively teleported. We're talking about a gain of 889%.
Which is it's a number that doesn't feel real. To put that in perspective for everyone listening, a massive day for a normal stock, even a volatile one, is what, 10%?
Maybe 20 if they cure a disease or something.
Exactly. If a major company moves 5%, it's on the news. TCGL did nearly 900%.
And that's before we even talk about the after-hours session.
Oh, that's a whole other level of insanity. So our mission today is pretty specific. We aren't just gawking at the number, though it is fun to gawk.
It is.
We need to unpack the anatomy of this explosion. We've pulled the trade logs, the short interest data, all of it, to figure out how a company goes from a penny stock to a billion-dollar valuation in, 6 hours?
And perhaps most importantly, we have to answer the question that's flooding every trading forum right now. Why are people calling this the next GME? Is this 2021 all over again?
It's the billion-dollar question. And the answer, I think, lies in the mechanics. It's a fascinating case study because it sits right at that intersection where market structure, it just breaks down and human emotion takes the wheel.
So if you're listening to this and you feel like you missed the boat, or maybe you're just seeing these headlines and thinking, how is that even possible? Stick around. We're going to break down the liquidity crisis, the short trap, and the psychological warfare happening on the order book right now.
Let's dive in.
Okay, let's start with the raw data, because I think we need to ground this in reality before we get into the wilder stuff. Let's rewind the clock. It's the morning of January 29th. Market opens at 9:30 a.m. What does TCGL look like?
It was invisible. It opened at $8.92. For all intents and purposes, it was a ghost, just trading sideways for months.
Less than $9, a lunch special, and then the closing bell rings at 4 p.m.
By the close, we're sitting at $86.36.
Wow. From 8 to 86, that's a 10 magger in a single shift.
That's the 889% gain. But here is where the story gets, darker, or maybe more exciting depending on your position. The madness didn't stop.
The after-hours market, this is where things usually get thin and volatile, right?
Exactly. And in that after-hours session, the stock ripped even higher. It tapped $114.
114.
That is another 32% tacked onto the 889%.
Let's do the napkin math on that because it's honestly hard to visualize. Let's say I'm a listener, and purely by luck, I bought shares the day before, on the 28th. I paid, about $8.73.
If you held through that after-hours high, you are currently looking at a return of over 1,200%.
1,200%. That's life-changing money in a 24-hour window. A decade of S&P 500 returns compressed into one day.
Or a lifetime for some portfolios.
Yeah.
And that's why this captures the imagination, right? It appeals to that lottery mentality. But we have to be careful. It's easy to look at the price and just say, wow, to understand how it happened, you have to look at the fuel.
And in the stock market, fuel is volume.
It's always volume.
Yeah.
Price creates the headline, but volume tells the truth about conviction.
So what was TCGL's volume like before all this?
Historically, TCGL is a sleepy stock. Its average volume was under 100,000 shares a day. Basically a dusty corner of the market no one was watching.
And on the 29th?
On the day of the explosion, volume hit approximately 5 million shares.
5 million?
That is 50 times the average.
50. That seems problematic for the plumbing.
It is. Imagine a quiet little side street that usually sees 5 cars a day. And then certainly, you route the entire traffic of a major highway through it in one afternoon.
The infrastructure collapses. Gridlock.
Exactly. The market infrastructure for that specific stock just couldn't handle the flow.
Yeah.
And that massive influx of volume has a direct impact on the valuation. We saw the market cap go from about $170 million to $1.76 billion overnight.
It became a unicorn, a billion-dollar company in a single workday.
Yeah.
Without selling a single extra widget.
Purely based on share price, yes.
But hold on, this brings us to the next GME thesis. We saw GameStop do this, we saw AMC. Why TCGL? Why now? Is it just the price jump, or is the plumbing actually the same?
It's the plumbing. It's almost a carbon copy of the structural setup. It's what we call the anatomy of the squeeze. There are 2 main factors here that you really need to understand. The first is something called the microfloat.
Okay, let's define that clearly. We hear float and shares outstanding, and I think people use them interchangeably. They aren't the same.
Not at all. Think of shares outstanding as the total number of tickets printed for a concert. For TCGL, that's about 20 million shares.
Okay, that's everything that exists on the books.
But the float is the number of tickets actually available for sale. It excludes the tickets held by the band, the promoter, the VIPs, who are contractually locked in and can't just sell them.
So the insiders, the CEO, the early investors, they're locked out. They can't just dump their shares because the price is high.
Right, usually because of lockup periods or SEC rules. So while there are 20 million shares outstanding, the tradable float for TCGL is likely under 10 million shares. It's a tiny supply.
So you have a scarcity problem right from the start.
A massive one. Now, remember that volume number. 5 million shares traded.
Right.
When you have 5 million buy orders hitting a market where there are fewer than 10 million shares available to trade, well, you have a liquidity crisis.
The supply vanishes.
Instantly. And this is the part people miss. When supply vanishes, but demand is skyrocketing, the price doesn't just go up gradually, it goes vertical. It has to. The market makers, the algorithms, they have to raise the price exponentially until they find a seller.
It's like an auction for the last bottle of water in the desert.
That's a perfect analogy. The price isn't determined by the cost of the water. It's determined by the desperation of the buyer. And speaking of desperation, that brings us to factor B.
The short trap.
The other half of the GameStop equation.
Right, because before this explosion, TCGL wasn't exactly a market darling. It was kind of a loser, wasn't it?
To be blunt, yes. Since its IPO in October 2025, the stock had been dead quiet. It was just stuck between $4 and $8.
So if you're a short seller, someone betting the stock goes down, this looks like a free lunch.
It looks like an easy target. Short sellers likely piled in, looking at this small, obscure company, expecting it to just fade away. They borrow shares, sell them, and plan to buy them back cheaper.
But then the highway traffic hits the side street. The stock hits $86.
And that creates the short trap. This isn't just about losing money anymore. It's about survival. They sold at $8, expecting it to go to $4. Now it's at $86. Their losses are theoretically infinite.
And their brokers are calling. The dreaded margin call.
Correct. The broker taps them on the shoulder and says, "You don't have enough cash to cover this risk. We are closing your position."
And to close a short position, you have to buy the stock back.
Right. So now you have these short sellers who think the stock is worthless, forced to become the most aggressive buyers in the market just to stop the bleeding.
And their buying just adds more fuel to the fire.
It's a feedback loop. Their panic buying drives the price up even more, which traps the next layer of shorts.
So you have the FOMO buyers who are excited and the short sellers who are terrified.
Both chasing the same tiny pool of shares. That is the recipe for a super squeeze. It's panic buying from greed and panic buying from fear.
Okay, so we understand the mechanics. It's a powder keg. But usually someone lights a match. Was there a match? What triggered this?
That is the mystery of the catalyst. And honestly, this is the part that makes institutional investors just pull their hair out. It's the no news paradox.
You're saying there was literally zero news, no press release.
Well, there was a press release, but not the kind you'd expect. The company actually released an official statement. They said, quote, "They are unaware of any undisclosed material information."
We don't know why our stock is doing this either.
Basically, yes. And paradoxically, that lack of news can actually fuel the hype even more.
That seems counterintuitive. You'd think people would say, oh, nothing happened, it's a fluke, I'm selling.
Not in this environment. Not in the meme stock era. When there's no official news, the vacuum gets filled with imagination. Traders start thinking, maybe the news just hasn't leaked yet.
Maybe someone knows something I don't.
Exactly. And it allows the narrative to be whatever the message boards want it to be. And right now, there is a specific rumor circulating.
I saw this. Something about Europe.
The rumor mill is buzzing about a major acquisition, something about a European expansion. And they're mentioning a company called FreeNow.
FreeNow, okay. But we need to be clear. This is unconfirmed. This is just a rumor.
Completely unconfirmed. It could be total fiction made up on a forum. But in the heat of a rally like this, truth matters less than the possibility of truth.
The market is pricing in a lottery ticket.
That's right. So let's look at the chart itself for a second. We've established it's a vertical line. I've heard it called a chimney or a God candle.
Those are the technical terms, believe it or not. A God candle is just a massive green candle that dwarfs everything that came before it, and it creates a situation called price discovery mode.
Unpack that. What does that mean when you're up 800%?
Well, look at the chart. The stock is at $86 or $114 after hours. It has never traded there before. There is no historical resistance. There's no group of people who bought it $100 5 years ago waiting to sell and get their money back.
It's uncharted territory.
It is blue sky. There is literally no ceiling. However, and this is the critical however that every listener needs to hear, there is also no floor.
Because it went up so fast, it didn't build any support on the way up.
Exactly. There is zero technical support between $86 and, say, $20. When a stock climbs a staircase, it builds support at every step. when it takes an elevator.
If the cable snaps, it's a straight drop to the basement.
Precisely. If the momentum breaks, the drop can match the rise in speed. And we have to look at the relative strength index.
Right, which measures how overbought or oversold a stock is.
Neutral is 50. Overbought, where you usually expect a pullback, is anything over 70.
And where is TCGL?
TCGL's RSI is at 99.16.
99.16? Is that even possible? I thought the scale only went to 100.
It's practically a mathematical impossibility in a normal market. It indicates extreme historic overbuying. The engine is running at 10,000 RPMs in the red zone. It suggests a pullback isn't just likely, it's screaming to happen.
So this brings us to the ultimate question, the verdict. We have listeners right now wondering, is this the opportunity of a lifetime, or am I about to get my face ripped off? Let's weigh the bull case against the bear case. Start with cold water. Give me the bear case.
The bear case is grounded in reality, in fundamentals. If you strip away all the hype, all the mechanics, and just look at the business, TCGL has about $2.4 million in revenue.
$2.4 million. I mean, there are individual coffee shops that make more than that.
Correct. But right now, the market is valuing them at $1.76 billion.
So the valuation is completely disconnected from the actual business.
It's a disconnect of massive proportions. We are talking about a price-to-sales ratio of 700x. Even the most hyped AI stocks usually trade at 20x or 30x.
700x is fundamentally unsustainable. And there's a specific risk for the shareholders here, right? If the stock is this high, what does the company do?
They print money. It's the only rational move. They see their stock at $100. They know their revenue is $2 million, so they issue new shares. An equity offering,
Which dilutes the current shareholders.
It floods the market with new supply. Remember, the scarcity of shares, that tiny float, is the only thing keeping the price up. If the company suddenly dumps 10 million new shares on the market to raise cash,
The squeeze is over.
that's the bear case, gravity and dilution.
Okay, that sounds pretty convincing. Math is scary. But clearly, people are still buying. The stock is at $114 after hours. So what is the bull case? Why are people holding on?
The bull case is that fundamentals have left the building. This is now a pure momentum trade,
Meaning,
that logic doesn't apply until the shorts are dead. If those short sellers are still trapped, and the volume suggests they are, they have to buy. It doesn't matter if the revenue is zero. If you owe shares to your broker, you are a forced buyer.
so the float is still too small to satisfy the panic.
Exactly. And psychologically, once a stock breaks $100, the retail targets shift higher. People aren't looking for $110 anymore. They are looking for $150.
200.
It becomes a self-fulfilling prophecy. The belief drives the price, which reinforces the belief.
For a while, yes, as long as the music is playing.
So we're looking at a game of musical chairs played at the speed of light.
100%. And the music will stop eventually.
For the listener watching this unfold tomorrow morning, what is the one thing they should be looking at? The one signal.
Watch the $100 level at the open.
2-century mark.
$100 is a massive psychological barrier. If the stock opens and holds above $100, the squeeze likely continues because it signals strength. It tells the shorts, we aren't leaving.
But if it cracks,
If it breaks below $100 and it can't recover, look out below. That psychological support can vanish instantly, and that's when you get the rush for the exits.
it's the difference between a launch pad and a trapdoor.
Exactly.
This has been an absolutely wild ride. It really highlights how the stock market isn't always a weighing machine measuring a company's value. Sometimes it's a voting machine or a slot machine.
It really challenges the definition of value, doesn't it?
It does, and that's actually where I want to leave our listeners today, with a thought to chew on. We spend so much time trying to analyze what an asset is worth. We look at revenue, profit, PE ratios.
The rational metrics.
Yeah.
The things they teach you in business school.
Right. But days like this remind us of a harsher truth. In a market driven by mechanics, by float, by short interest, by panic, the price of an asset isn't what it's worth. The price is simply what someone else is forced to pay for it right now.
That is a terrifying and an accurate distinction.
Value is theoretical. Price is what happens when you have to close a position.
And being able to tell the difference is usually what saves your portfolio.
Couldn't have said it better myself. Thanks for diving deep with us on this one. It's going to be an interesting week.
It certainly will be.
Catch you all on the next deep dive. Stay curious.
Don't forget to like, share, and subscribe for more.